Today, the US Treasury, the government department that borrows and manages America's debt, made an announcement. In plain words, they said they will buy back more of their own old long-term loans, the ones that run for 10 to 30 years. And to pay for those buybacks, they're going to borrow fresh money using short-term loans, the kind that get repaid in under 2 years. So imagine the US government has two kinds of loans, a 20-year loan and a 2-year loan. Today it basically said, we're going to use more of the 2-year loan to pay off chunks of the 20-year loan faster than before. That's it. That's the announcement. Sounds boring, even technical. But within hours, gold jumped $135, one of the sharpest moves you'll see. If a debt management announcement can do that, you need to know why. Stay with me for the next few minutes. Here's the announcement in plain English. The US Treasury, the department that manages America's debt, said it will buy back more of its own long-term bonds. We're talking bonds that mature in 10, 20, even 30 years. To pay for these buybacks, it will issue more short-term debt, Treasury bills that mature in under 2 years. Think of it like this. Imagine you have a 20-year home loan and a lot of short-term credit card debt available. Instead of paying down the credit card, you use the credit card to buy back your own 20-year loan early. You've swapped long-term debt for short-term debt. That's exactly what the US government is doing, at massive scale. Officially, the Treasury is being careful to say, this is not quantitative easing. Quantitative easing is when the central bank, the Fed, creates new money to buy bonds. This is different, it's the Treasury itself managing its own debt mix. No new money is technically being printed. But smart money sees right through the claim that this is not quantitative easing, and here is why. When you constantly buy back long bonds, you're artificially propping up their price, and when bond prices go up, yields go down. That's the entire playbook of something called yield curve control, or YCC, where a government actively caps how high long-term interest rates can rise. Japan did this for years. The result? Their currency weakened over time, and inflation, which had been dead for decades, came roaring back. Analysts are now drawing comparisons to Brazil in the 1990s, a period when the government was forced to roll over almost all its debt overnight, in very short maturities, because nobody trusted it with long-term money. That's an inflationary spiral warning sign, not a stability signal. So the market's read is simple. The US Treasury Secretary Scott Bessent is signaling he will protect the bond market, keep borrowing costs manageable, even if that means letting the dollar and inflation expectations drift higher. In trader language, he's choosing to save the bonds, not the dollar. This isn't happening in a vacuum. Look at the timeline. Trump nominated Kevin Warsh to the Federation. The Senate advanced his nomination. Powell's term ended in May. Warsh was sworn in. He's given 2 speeches since. Through this entire political transition at the Fed, watch what happened to the 2-year and 30-year yields. They crept higher, not lower, even as the new Fed chair took over. That tells you the bond market doesn't fully trust that this transition brings lower inflation. And through the exact same window, gold went from around $4,331 to $4,495. Gold has been the one asset consistently pricing in currency and policy uncertainty, while the dollar index has stayed choppy, roughly range-bound between 97 and 101. Okay. Theory aside. Let's make this real for an Indian trader or investor. 4 things to watch. First, gold. This is the most direct trade. If global investors are losing a bit of faith in long-term bonds and fiat currencies, gold is the release valve. In India, that shows up in MCX Gold futures, gold ETFs and sovereign gold bonds. Don't be surprised if domestic gold prices keep grinding higher. Remember, Indian gold prices are a function of both the international dollar price and the rupee. If the rupee weakens even while dollar gold rises, the effect compounds for Indian buyers. Second, the rupee and RBI. A Treasury effectively capping long-term US yields, combined with a possibly more dovish Fed under a new chair, is generally rupee supportive on paper. Lower US real rates can pull foreign money into emerging markets like India. But if inflation fears globally start rising, the RBI has to walk a tightrope, cut rates to support growth, or hold firm to defend the rupee and keep inflation anchored. Watch RBI commentary closely over the next few policy meetings. Third, NIFTY and SENSEX sector-wise. A weaker dollar environment historically helps FII flows into Indian equities. That's a tailwind for the broader index. But go sector by sector. IT services companies like TCS, Infosys and Wipro earn in dollars. A structurally weaker dollar can hurt their rupee-translated earnings. On the flip side, gold and jewelry names like Titan tend to benefit directly from rising gold prices through inventory gains and stronger demand psychology. Banks and PSU names with large bond holdings should be watched too. Global yield moves ripple into Indian G-Sec yields. Fourth, Indian bond yields. Keep an eye on the India 10-year G-Sec yield. Global long-term yield stability, even if artificially engineered by the US Treasury, tends to keep a lid on Indian bond yields too, because global capital compares relative yields across markets. So what's the simple takeaway, even if you're new to markets? This isn't a call to panic or to go all in on gold tomorrow morning. It's a signal to widen your lens. When a government starts managing its own bond market this actively, it usually means one thing over the medium term: currency and inflation risk rises, even if interest rates look controlled on the surface. For a trader, that means, don't ignore gold as a hedge in your portfolio, however small. For an investor, that means, don't assume stable interest rates equals stable currency. They're not the same thing anymore. And for anyone tracking NIFTY, remember global liquidity conditions, not just Indian earnings, are increasingly the tide that lifts or sinks the boat. That's the decode. 1 Treasury announcement, 3 big signals: no quantitative easing on paper, yield curve control in practice, and gold telling you what bonds won't. Follow us for the next breakdown. Because this story isn't over, it's just getting started.